Good morning and welcome to today's live technical analysis. We're going to be starting off with the euro against the US dollar. So just setting up our chart, toolbars, line studies, and then the time frames. So we're going to be staying on the forward chart as we usually do. So there's two ways that you can look at the euro dollar chart. One could be in terms of a bull flag, which was broken. So that would have been one, and then running along here, breaking, moving higher. On the other hand, you could see this as a slightly sideways moving channel. Let's set the properties, view indicators, then let's go to volume base. And let's remove this indicator list. We have bone volumes, RSI, Bollinger Bands. So we have volume, the RSI, and then the on-graph volume as well. So based on what we're seeing, one could be a bull flag, so perhaps moving higher. RSI between 50 and 70, so implying a slight bullish market sentiment, or it could be moving in a sideways fashion between S1 and R1. After failing to break below numerous times on S1, simply look at the price action. It appears to be moving in an upwards fashion. So we maintain a neutral or sideways bias, like call it that, for the pair, remaining between S1 and R1. If it breaks above R1, we would switch to a bullish outlook. Volume appears to be declining slightly as well. Small temporary. So let's just check this as well. So you could say that it is moving in a sideways fashion for now, if it remains confined between S1 and R1. The narrowing of the Bollinger Bands also imply low market volatility, and as such further aiding to our theory that it may move in a sideways fashion between S1 and R1. For a bullish outlook, we'd like to see it break above R1, aiming for R2. For a bearish outlook, on the other hand, simply breaking below S1 would suffice as a switch towards a bearish outlook. We're not going to be switching our support and resistance levels, so you can just take a moment and plot these on your graph as well. Why? Well, it's failed to break below S1, so S1 continues to hold. We have S2, 1.0575, slightly higher. Then R1, R2, and R3. And given that R1 has not been broken yet, we're maintaining R1. Had we brought R1 lower, it would have been broken already. And as such, we're taking this previous high and keeping resistance at R1. Moving on to the British pound against the US dollar, so cable. On a political level, we note that former Prime Minister James Cameron has returned as foreign secretary, although not possibly impacting the pair in terms of a market reaction. From a political level, it may support the Conservatives' poll numbers, which, according to a recent poll by Political, were at roughly 24%, if I'm not mistaken. So, given that there's elections for the UK Parliament preparing to take place, and we're seeing that there's a shift away from the Conservatives, it may boost their poll numbers. So that's more of a political gimmick, I'd say. So no real impact on the markets. For today, we note that the UK's employment data came in slightly better than expected in terms of the unemployment rate and the average hourly earnings. However, in terms of the 3-month employment change figure, it came in lower than expected at minus 207K. That could have perhaps weakened the pound, but it appears the better than expected unemployment rate and the average hourly earnings appear to be supporting the pair's upwards trajectory. So it's a testing R1, 1.2305. We could see the formation of an upwards moving trend line as well if we simply extend our chart. Testing resistance. For a bullish outlook, it would need to break above R1 and actually break above this previous high, which was the beginning of our downwards moving trend line. Next target being R2, 1.24650. For a bearish outlook, it will need to break below S1 and move towards S2, whereas for a sideways fashion, failing to break above R1 and failing to break below S1 and moving between these two pairs. The narrowing of the Bollinger Bands may imply low market volatility, but given that the RSI is on an upwards trajectory, it may imply that the pair is moving in an upwards fashion. So for now, we'll be maintaining a bullish outlook for the pair, given that it's testing resistance at 1.23050. If we drop down to the 15-minute chart, you can see it's currently at R1, moving in an upwards fashion as well. 30-minute chart, it's broken above. 4-hour, just broken above R1. If it breaks R1 by the time we're finished, I'll readjust this chart for your so that it's easier for you to see. Now, dollar JPY, we have Japan's trade balance data, if I'm not mistaken, is due out on Thursday morning. Found support at resistance and support 151.65, slightly moving in upwards fashion. Finance Minister Suzuki said that a weak yen also has its benefits. The question is, how much weaker will the yen go? We're seeing that it's meeting some resistance at this point, so we could bring R1 at this point, but given that we're keeping S1, I'm going to be removing R1. This could be a temporary resistance level. So even though from a technical point of view, it may be supporting a bullish outlook given that the RSI is still near 70 and it's above 151.65. From a fundamental point of view, I'd be maintaining a bearish outlook for the pair. It's broken below our upwards moving trend line, founding support. I would not be surprised if by tomorrow this is support turned resistance. I do not think this is a government intervention in the FX market. Let's just insert shapes, clips. As I said, I do not think this is a government intervention, and I'll show you why. I believed that this was a government intervention, and if you compare the two, this is minimal. This could be simply by the market and not the government. If it was, it would have been probably much larger in size. So from a technical point of view, you may support, may be supported that it's moving in upwards fashion, but from a fundamental point of view, I'd be maintaining a bearish outlook for the pair. Let's just check the volume as well. Declining volume, so I'd be maintaining a bearish outlook for the pair, at least for now. Australian dollar against the US dollar, so the Aussie, broken above our downwards moving trend line, so we could readjust S1. Previous low 0.63205 or 0.6320. Then we readjust our S2, looking at historical data, I'll take this point 0.6203, or we could say 40. I think that these larger moves are more indicative of a significant support level should come back down despite this lower low. Well, not lower low, slightly higher low compared to these two candles, but given the sheer size of the bearish and bullish candle, I think this provides more support should the pair move lower. So we have R1, R2, R3. S1, S2, S3. More of a macro time frame, but sideways given that RSI moving towards 50, narrowing of the Bollinger Bands is at the mid-range, broke above our downwards moving trend line, so maintaining a neutral outlook for the Aussie. Dollar against the Canadian dollar, testing resistance at 1.3820. Next intermediate target could actually be slightly lower. But given at where it is now, it may have been prudent to have kept RS2 at its previous level, which, let's see, was at this previous high. $1.391, well, 1.3920. Let's just make sure that we haven't small mistake. Dollar CAD. And then this could be S3. It's all-time high. $1.3978. So you have R1, R2, and R3. Appears to be moving in a slightly upwards fashion. You could say that this might be a formation of a upwards moving trend line. RSI bounced off 50, moving towards 60, testing R1, maintaining a bullish outlook for the dollar against the Canadian dollar. So for the loonie. Gold broke below support, turn resistance, currently above. We need to readjust our support and resistance levels. And we could bring, let's see. This could be the first level of resistance, 1,955. I'm coinciding this strong bearish candle with the wick to the left of your screen. This point here, which was the formation of upwards moving trend line, 1,954. Then for R2, perhaps slightly lower. $1,977. And then for R3, 2005. S1, 1,932. And then for S2, 1,880. But the difference is far too large compared to our resistance levels. So this is more of a short-term outlook, perhaps up until tomorrow. If we're looking on a more macro level, we would have placed our support and resistance levels much further apart. But for now, since this is a temporary technical analysis, perhaps for today, 1,890. And then for S3, way too far away from S2. $1,868. But given that we're placing it lower, 1,895 for S2. And there you have S1, S2, S3, R1, R2, and R3. Although, please do note, this is on a very short-term outlook for the next day or so. RSI near 50. Perhaps you could say it's moving in a slightly sideways fashion. Mid-range of the Bollinger Bands. Bullish outlook would need to break above R1, aiming towards R2. Bearish outlook, simply moving below S1 would suffice. This could be the formation of which was broken as well. So we're maintaining a neutral outlook given that it's broken a second downwards moving trend line as well. Our sign is still near 50, therefore neutral market sentiment. Oil, let's look at oil. So the EIA production report that came out yesterday showed that productivity has increased despite the reduction in oil rigs, in combination with the monthly report by OPEC, which clearly stated that the negative market sentiment towards the Chinese economy is essentially too much. On a fundamental point of view, they're maintaining their outlook for the Chinese economy in terms of their consumption. Therefore, based on that, that could be the predominant leader in oil's upward direction for today. Slightly lower today, moved higher yesterday, but overall appears to have moved slightly higher, formation of an upwards moving trend line. S1 and S2 are still close together, so for a bearish outlook, we would need to break below S2 as well, not simply S1, but these may be temporary support levels, and we're going to be keeping S3 as we're keeping R3, given that these are fairly close to each other. But for R3, actually, we could bring it slightly lower. 87.05. And then S1 and S2 are far too close for my liking, but at this point in time, we're keeping them. So for a bearish outlook, breaking below S2. Bullish, simply breaking above S1, excuse me, R1, aiming for R2, upwards moving trend line. Perhaps for the next day, bullish outlook on oil. The second outlook would be a neutral outlook, given that it's broken above 77.25, so remaining between S1 and R1. And lastly, for a bearish outlook, breaking below S1 and S2. We're going to be looking at stocks today as well, notably Airbus and Boeing. Based on the fact that President Xi Jinping and US President Joe Biden are meeting today, if an order deal is announced by China in order to buy airplanes from Boeing, it may hurt Airbus's stock. Why? They're competitors. If Boeing is doing better, it would make sense that Boeing stock moves up whilst Airbus's moves towards lower ground. Despite on a technical basis, it does appear that Airbus is actually moving in upwards fashion. Could be in anticipation of a potential deal. But we're going to be looking at Boeing, given that we've talked about Boeing. We'll come back to Airbus at the end of our technical analysis. So you have Boeing. Let's look at the 4-hour chart. Let's just fix our chart as well. Going to go here, show grid, open, high, close. Zoom in, jump higher. Could be on perhaps in anticipation of a deal being made for the purchase of airplanes, which could support the stock's price. Shapes rectangle, this could be a breakaway gap highlighted in yellow. So S1 here, actually 203.17 for S1. Let's show this in green. So I would not be surprised if this 4-hour bullish candle actually comes back down to test S1, validating that this is indeed a breakaway gap and then moves towards higher ground. And as such, we'd place S2 on the closing of this bullish block as well, under 96.65, and then for S3, where this opened and actually where this closed and where this bullish candle opened, under 86.15, and then for R1, Look how it's coinciding this wick, validating resistance, closing of this bullish candle, opening of this bearish candle, moved lower. It failed to break above, as well as failed to close and opened and then moved higher. So R1, 211.55. Then we could place R2 at this previous low. We'll take this previous high. We could take this previous high, or we could take the line in between these four candles. So one theory could be previous high, yes, might find some resistance. On the other hand, slightly higher, I think there's more liquidity, so more selling pressure at that point. That remains to be seen, but this is where I think the next potential resistance level would be. It's coinciding more with this bearish candle wick that came back up to test resistance before moving lower, therefore resistance level. And then for R3, previous high, 228.80 for R3. It appears to be moving in an upwards fashion with an upwards moving trend line as well. Broke higher, so maintaining a bullish outlook for Boeing. And let's just add the Bollinger Bands. It actually might be overbought. Let's just validate that with the RSI indicator. Yes, it's above 70, but not too far. So it's near 76, implying there is a strong bullish market sentiment. If there is no deal announced, then I would not be surprised if this comes back down. But for now, perhaps coming back to test this breakaway gap before moving higher. But based on a fundamental and a technical point of view, bullish outlook, although it could come back down to touch the Bollinger Bands and then move higher. Starbucks, workers are anticipated to go on strike this Thursday. So that could potentially weigh on the company's stock price. Move on to the 4-hour candle chart. Let's see. Let's place support and resistance. Support, wick validated, bearish candle, 99.87. Let's just change this to green. So I have S1. Let's see. I'd like to see something as well. There's a big gap here, and then there's a huge one here as well. So that could be S1. And then S2. There's a lot of liquidity at this point. So it could either be around here from a more macro perspective, 99.87, 94.55. Then you take S3, lowest point. So this was a swing low, moved higher, higher low, and then jumped higher, 89.30. From a fundamental point of view, 9.30. From a fundamental point of view, I would be bearish on the company stock price, given that if you're going to be having strikes, then that does not bode well in terms of PR And if your workers aren't working, then that means you're making less coffee, thus less profits. So bearish on the company stock price, but if it does move higher, we're placing our resistance levels, coinciding as well in terms of distance with the support levels. R2 would be 108.90, and then I place R3 where this gap was formed under 13.70. But if we add some indicators as well, Bollinger Bands, accumulation distribution, insert indicators as it's just RSI, dropped below 70, 64, aiming towards 50. So bearish outlook from that indicator, and then the Bollinger Bands, extremely wide, high market volatility, moving lower towards S1. Bearish outlook would need to break below S1 as well, and then would maintain a bearish outlook. If it fails to break below S1, sideways. If it breaks above R1, bullish, although I do not think that will be the case. Walmart has earnings this week, as well as Home Depot, so retail giants in the US. Based on what they are, in terms of the earnings, we may see appears to be moving in an upwards fashion. So from a technical point of view, bullish outlook, and you could actually see an upwards moving channel as well. Channel properties, let's make this slightly more thinner. Going to removing this trend line. There's two touches, validating, and then two more. Just not so upwards moving channel, bullish outlook, and then for support and resistance levels, higher low, 163.60. So this would be S1. And then I take S2, 158.55. Then for S3, beginning of our upwards moving channel, 154.05. And now for resistance. Okay. So let's put resistance. It's at 167.61. The next, I'd say, big figure would be 168. $168 at this point, so this could be R1. Why I'm taking big figures? Then I'm going to measure the distance between S1 and S2 to find R2. It's about 50.97. Then let's just reflect that. 497. $173. Also a big figure as well. So, and then between S2 and S3, 59. $177.70. For R3. Appears to be moving in upwards fashion, aiming for resistance at 168. If it does break above R1, next target potentially being R2. Let's just add some indicators as well. Upwards fashion, so I'm guessing RSI could be roughly at 70 as well. But let's see. 66. So bullish outlook for Walmart. Home Depot. Home Depot, on the other hand, paints a different story. Should appear not to be a general market sentiment. Walmart is moving upwards fashion, while Home Depot appears to be moving in a downwards fashion. Let's add our Bollinger Bands as well. indicators. RSI. RSI appears to be hinting at a bearish outlook for Home Depot. Let's see why. Testing support 268.69, so that would be S1. And then S2. Previous low 265.90, and then S3 250.60. And for R1, heavy resistance here. So this was support and resistance. 294.28. So R1, R2, 314.75, R3, 329.35. So R1, R2, R3 was moving in an upwards fashion. Broke below, moved lower, so I switched to a bearish outlook, breaking below S1. Next potential target could be S2, although that's a big distance for it to travel. So something more prudent could be at the beginning of our upwards moving trend line, 275.95, and then readjusting R2. These two candles slightly higher, 304.35. And then 314.38 for R3. And we'd have to readjust our support level at S3 as well, given that we've readjusted everything else. So for S3, let's bring it slightly higher. Nope. That was S2. And S3, 267.05. From a technical point of view, it appears to be moving in a downwards fashion. We haven't done Google. Let's do Google as well. Apple. So it appears that Google is paying Apple about 34 or 36% in revenue generated by Safari. So that in turn could weaken Google's stock price, as they're paying a significant amount of ad revenue to Apple, and could boost Apple's stock in as a result. So shows that Apple is making actually a decent amount of money from ad revenue as they're being paid by Google. So I've simply placed our support levels. As you've probably noticed, I'd like them coinciding. I take the opening and closing figures. I think they're more significant than rather using the wicks. Where it closes and opens is more, I think, indicative of where we might find support and resistance. Broken below, and this is Google. So bearish outlook on Google as well from a technical point of view. We just bring this lower. As you can see, this wick tested resistance on 131.97. and that would be R1, R2. Although based on how we've placed S2, R2 on 136.01 might be more, 136 might be more prudent, and then R3 came back up, tested, but we could take this previous high for good measure, 139.15, maintaining a bearish outlook on Google, or at the very least a sideways fashion. Let's add our indicators as well. Extreme volatility, and then oscillators RSI. So appears to be losing some momentum near 50, so it could be a sideways fashion between S1 and R1, although pretty close to each other. So for a bearish outlook, breaking below S1 and moving towards S2. For a bullish outlook, breaking simply above R1. Sideways fashion remaining between S1 and R1. And we're going to be doing one last stock. We've done Walmart, we haven't done Airbus, we've done Boeing though. Airbus, Commerce Bank. We could do, let's do Apple, based on the fact that we were talking about it just moments ago. Apple 4-hour chart. As you can see, it broke our previous resistance that we had. Support 182.19. So it's finding some support at that point. We could keep S2 as it was, or we could simply readjust it slightly lower. 175.55. Now we need to readjust our upwards moving trend line. Just move this. Upwards moving trend line. So from a technical point of view, bullish, and from a fundamental point of view, continuing to validate our bullish outlook. We're keeping S3 169, and then we need to adjust our resistance levels. So we've kept R1 189.50, R2, and then we're going to be placing R3. Before this split, 202.38. And now we have S1, S2, S3 in addition to R1, R2, R3. Upwards moving trend line, RSI near 70, broken above resistance to support, all hint towards a bullish outlook for Apple. And from a fundamental point of view, continues to validate our hypothesis. And with that, that does it for today. Thank you for watching.
everyone, my name is Emily. In our video today, we will talk about why having a forex trading strategy is important. Trading on the global forex market presents the opportunity for a quick profit turnaround for traders and offers significant potential. However, as the most liquid market in the world, it is both complex and highly competitive. This means that in order to be successful, you need to have a solid trading strategy in place. Forex can be traded in numerous ways, so it is very important that you go with an approach that suits your experience level, budget, and trading goals. Having a proper understanding of the market you're entering into and the strategy that is needed can be the difference between trading success and failure. Choosing a forex trading strategy is similar to buying a new car. There are a lot of choices and they come in different types. It is also important that you test drive a new strategy via demo account before proceeding with it on the real world markets. Thank you so much for watching us today, guys. Bye-bye.
Okay, let's go ahead and get right into it. So, as per usual, a risk warning and disclaimer before I get started. So, our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. A disclaimer: the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. Iron FX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie. I will be your speaker for today. I am an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research from 2019 to 2021. So here's our agenda for today. We're just going to look at some fundamentals first, and then we'll look at some trading strategies for gold, some indicators that you can use, and I've also included some stop loss techniques, so some exit as well as entry rules as well. Okay, let's get started. Feel free to let me know throughout the webinar if you guys have any questions. Just let me know in the chat. Okay. So, firstly, we're going to start off with the fundamentals, okay? So we're going to firstly look at the demand and production of gold worldwide. So starting off, there are a couple of sectors that are high in demand for gold. If you can see in this chart that I got from Statistica, you can see that jewelry amounts for 55.43%. So, and it also represents the largest source of annual demand for gold per sector. However, this has declined over recent decades, but it still accounts for around 50% of total gold demand. And if we're talking about worldwide distribution, we're mainly talking about India as well as China, which are by far the largest jewelry markets, together accounting for over 50% of the global total. Okay, the Asian as well as Middle Eastern markets are dominated by demand for purer and higher carat gold. Next, we have investment. So because it has unique properties as an asset class, which we'll get into in the later slides. So our analysis shows that modest allocations to gold can actually be proven to protect and enhance the performance of an investment portfolio, which is a sentiment that a lot of investors also follow, because they think that it will reduce volatility as well as minimize losses during periods of market shock. Okay, so investors of all sorts are in recent years coming to accept gold as a reliable, more tangible long-term source of value that has moved independently of other assets. Next, central banks accounts for 11.33%. And gold plays an important part in global central bank reserves, and they tend to be more significant holders of gold. Okay, so since the 2008 financial crisis, it actually prompted a fundamental shift in central bank behavior towards gold, and it encouraged a reappraisal of its role and relevance in reserve asset management. Okay, so just like how we're talking about individual investors, central banks also have adopted this sentiment. So emerging market central banks have increased their official gold purchasing, while European banks have ceased selling, and the sector now represents a significant source of annual demand for gold. And lastly, we have tech. So tech amounts for 8.21% of gold demand. And how it's used in the industry is mainly, okay, there's a broad range of applications, but demand is mainly driven by the electronic sector. So it accounts for about 80% of the gold that's used in technology. The metal is ubiquitous, and most consumer electronics as well as automotive applications, because of its chemical and physical properties, which when combined, it makes it irreplaceable in many high-end devices. Okay, let's move on. So the 2021 gold consumption, this is across a couple of major economies in the world, but you can see that the largest consumer of gold in the world in 2021 is China as well as India, which is what we talked about in the previous slide. As well as China and Russia, which have been the two world leaders in the move to holding larger gold reserves. So this is a pretty outdated graphic. This is from 2021. Okay, so just keep that in mind. Okay, so this is the 2022 gold demand. And 2022 was actually the strongest year for gold demand in over a decade. So, it says here in this chart, 2022 gold demand almost matched the 2011 record. So colossal central bank purchases aided by vigorous retail investor buying, as well as slower ETF outflows, lifted annual demand to an 11-year high in 2022. Okay, it actually saw a total annual gold supply increase by 2% last year. Okay, and this is the 2022 CIC gold production. So China produced 330 tons, Australia 320, Russia 320, Canada 220, and US 180. Okay. Okay. So next, let's talk a bit about how gold is used to hedge against inflation as well as crisis. And with people speculating on an upcoming recession, we could be seeing gold being bought a little bit more in the recent months, as well as in the coming months. Okay, so in this graphic here, we're talking about how gold's value increases traditionally during recessions. So gold has been traditionally considered a safe haven asset for investors when markets are in turmoil. So how does gold hold up when the economy tumbles? Okay, so this graphic uses data from macro trends to highlight gold's price movements during recessions and compares it to the changes in the S&P 500. Okay, so it compares the value of gold to the S&P 500 in historical recessions. So if we're mainly talking about, I think over here, the first recession you see here is the 1973 recession. Gold increased by 87%, while the S&P 500 dropped by 13.1%. Okay, the recession length was about 16 months in 1973. If we look at a more recent recession, okay, I think the most recent one would probably be the 2020 recession because of the pandemic and the lockdowns. So that lasted approximately about 2 months, and the percentage change in nominal price of gold was 5.6% increase, and whereas the S&P 500 dropped by 1.4%. Okay, and here it says gold's price reached an all-time high during the pandemic, briefly hitting the $2,000 per ounce mark. Okay, so since 2022, because the global economy has kind of been shaking with the onset of a couple of wars, as well as countries coming out of the pandemic, as well as facing high inflation, so on and so forth. I'm sure you guys know. So investors are speculating that it might be gold's time to shine in recent years from 2022, even until now, 2023. Okay, but in fact, history shows that gold often outperforms US stocks and the dollar following interest rate hikes after underperforming in the lead up to rate hikes. Additionally, high inflation is eroding the purchasing power of each dollar, incentivizing investment in a tangible asset like gold, as well as other hard assets. Okay, so with geopolitical uncertainty around the world at a high and the US consumer sentiment at decade lows, what do you guys think about how gold will continue to be a safe haven asset as we move on to 2024? Feel free to let me know in the chat. Okay, I'm just gonna continue. Okay, so this is just a gold versus US recessions chart. This is a weekly chart, that just measures gold futures as well as the period of recessions, on a weekly time frame. And then if we look at gold versus inflation, you can see that it's kind of negatively correlated. As the CPI rises, we can see that the value of gold rises as well. Okay, let's move on. So now we're talking about the US dollar relationship. So relationship with gold. So we see here the robust labor market basically indicates that the Fed will probably keep rates higher. There's a high chance that rates will probably not be cut so soon. And if we look at DXY as well as bond yields, they've spiked on stronger than expected employment figures. Okay, however, these moves were short-lived. So gold versus DXY historically have been negatively correlated. Okay, so if you take a look at this chart, September, whenever we see a rise for the DXY, we can expect the gold to drop. And if DXY drops, we can expect the opposite for gold as well. Okay. Next, let's look at the gold versus US 10-year bond yield. So recent ISM data suggests that inflation is increasing in both manufacturing as well as the services industry. But depending on CPI data, we could see some increases, these increases being fed into the CPI data. So once again, you see that the 10-year bond yields are negatively correlated to our gold as well. Okay. Of course, this doesn't always happen, so you have to do your own comparisons, and maybe I'll show you guys how you can check out or how you can compare the charts on TradingView. Okay, let me just pull up my charts. Okay, so we're talking about gold. Okay, and if I want to add another chart so that I can compare it right on the same chart, I just press this addition sign and then click on this same percentage scale. Okay, you can of course click on the new price scale, but then you would be comparing on a different scale. So I just like to click on this one. Okay, and you can see as I've explained before, the DXY or the US dollar tends to be negatively correlated to gold. Okay, so when you're analyzing, you can use this feature. Wait, let me see. Can you guys see my screen? Yeah, okay. Yeah, you can use this feature to basically analyze two charts at once. Okay. Okay, let me know in the chat if you guys have any questions. Okay, if it's all good, let's continue. So now we're going to be talking about the real yield relationship with gold. Okay, so government bond yields are quoted in nominal terms, i.e. the US 10-year bond yield, and real yields are adjusted for inflation expectations. So real yield equals to nominal bond yield minus the expected inflation rate. Okay, now if we look at this chart, this is gold versus real yields. Inverted real 10-year treasury yields. So the interpretation of this, maybe I'll just pop the website into the chat for you guys to take a look at. But the interpretation for this is that the real interest rate is defined as the difference between the nominal interest rate and the expected inflation rate. Okay, so the correlation between real interest rates and the price of gold in this chart is minus 0.82. So basically, when real yields go down, gold goes up. So this links closely to what we've been talking about throughout the webinar, which is that, DXY S&P 500 tends to be negatively correlated to gold. Okay, but we can see now that real yields are also negatively correlated. Okay, so this correlation explains why inflation is gold's best friend, while rate hikes are probably its worst enemy. Okay, so the reason for this is because rising interest rates also mean rising opportunity costs of holding gold. So gold neither pays dividends nor interest. So it's relatively expensive to hold it in the portfolio when interest rates are high. On the other hand, when real yields are negative, holders of cash and bonds are losing wealth. So investors are more prone to buy gold in that scenario. Okay? Okay, now that we have gone through the fundamentals of gold and understanding kind of the science behind gold, let's take a look at some technical analysis tools that you can use when you are trading gold. So trading gold is pretty similar to trading any other currency. Of course, the only addition is that you should be taking note of your fundamentals as well. The fundamentals that we've mentioned previously. Yeah, specifically for gold. But as for your risk management strategies, they should be about the same as any other currency. Okay, so let's take a look at some trade management strategies. Okay, so the anatomy of a trade, basically you guys know this. This is pretty basic. Your entry, stop loss orders, take profit orders, but it also takes into account your break-even, partial profit, idea and validation, trading stop loss, as well as diversification of your portfolio. So we go through these more in depth in our other webinar series on risk management, but I'll just go through a couple of exit strategies as well as entry strategies in this webinar, and then we'll take a look at the gold charts after this. Okay, so why is it important for trade to have a trade management strategy? Firstly, is to control risk. Okay, so trade management strategies such as stop loss orders and position sizing helps traders to limit their potential losses and manage their overall risk exposure. Next, we have maximize profits. So trade management strategies such as take profit orders, as well as trading stops that we'll get into a bit, helps traders to lock in profits and maximize their returns. Thirdly, manage emotions. So the discipline and structure that trade management provides can help traders to stay calm and rational even in volatile markets, which can prevent impulsive decisions driven by fear or greed. Fourth, improve trade efficiency. So by having a well-defined trade management plan, traders can make faster, more informed decisions and avoid the cost and time of having to constantly monitor and adjust their positions. 5, increase consistency. So effective trade management strategies helps traders to achieve consistent results over time by reducing the impact of individual losses and maximizing the impact of winning trades. Okay, so problem with a fixed take profit or stop loss. Okay, so let's take a look at this example. The red area shows a strong resistance area since there have been 2 swing highs in line with this level. Okay, if our trading strategy requires us to have a fixed take profit of 100 pips, we will place the target beyond this strong resistance area. Okay, so let's see how this plays out. You can see price shot up, but it missed it by a few pips before reversing back down. The reason for this is because price tends to reverse off of big areas of resistance and support. Okay, so in an alternative scenario, if we had placed our take profit before the key resistance area, we would have gotten a profitable trade. So it's important to look at the charts and adjust your take profit and stop loss accordingly. Okay, so this is the proper stop loss and take profit placement that we tend to recommend. Okay, so your stop loss, we typically recommend you to place it beyond the major resistance area, and the take profit will be placed before it. Okay. Okay, and this is the reason for it. Okay, because price is attracted to strong areas of Fibonacci. So when we're talking about confluence, here we're talking about Fibonacci confluence, but it could be confluence for anything. So if you're using pivot point levels, if you're looking at dynamic support and resistance by using your Ichimoku or Bollinger Bands, any indicators that you like to use, even your support and resistance levels, okay? When two or more of those indicators line up at a specific level, that forms a confluence area. So price is attracted to such areas of confluence, and if your stop loss is right before it instead of beyond it, you'll most likely get stopped out before the market reverses. So that's why people might wonder why they got stopped out right before the market starts to reverse and then complain about stop hunting. So if we're talking about take profit, we always recommend you to place it before a key confluence area. The reason for that is because when price reaches the confluence area, there's a high chance that it won't be able to go beyond it because of the amount of resistance or amount of support at that area. Okay, so instead of reaching your profit target, it'll reverse back to your entry or worse, your stop loss. So that's also one of the reasons why people complain that the market is being manipulated, because they miss their take profit by 1 pip. Okay, here's an example to show you why you shouldn't have a fixed stop loss. So this applies for really any trade that you are looking at. It doesn't just have to be for gold. Even if you're trading currencies, it's the same thing. Okay. So here's an example. So here we have a support level with two swing lows that are in line with one another. Price has bounced off this support level, and we are expecting it to continue to rise to the swing high resistance. So our stop loss of 100 pips is fixed at the 1894.75 level. Okay, which is at this support level here. Okay, but instead of heading towards our take profit, price actually goes down and touches your stop loss and bounces up perfectly. Okay, so what we should have done instead was to place our stop loss slightly beyond the key level of support or resistance so that we are not stopped out at the support, since price tends to be attracted to key levels of support and bounces off of them. Okay, so let's talk a bit about some entry and exit. Okay, in this case, we're talking about stop loss placement. So exit strategies. Okay, so this is why it's important to have dynamic stop loss and take profit placement. Dynamic stop loss is a trading strategy that's used to manage risk, in which the stop loss level is adjusted dynamically based on market conditions. The level of the stop loss is continually moved to a more favorable position as the price of an asset moves in the desired direction. The goal of a dynamic stop loss is to lock in profits while minimizing potential losses. So the placement of the stop loss can be determined by various technical analysis indicators or other market conditions, such as volatility or market trends. Okay, so let's look at some indicators that you can use. Okay, so firstly here we are looking at a simple example to demonstrate a dynamic stop loss. Okay, so price firstly bounced off nicely off of the support level here. So it's a swing low support at 86.721. Okay, and we're expecting it to reverse off of our entry at 87.819, which is also in line with this 100% Fibonacci projection level. Okay, so we see here that if we're thinking of where to place our stop loss is over here at the swing high, which is also in line with minus 27.2% Fibonacci expansion, as well as the 61.8% Fibonacci projection. And you can see price did rise to our entry and is kind of testing this area here. Okay, so the stop loss should be placed beyond the Fibonacci confluence area instead of before it, like you see here. Okay, oops. And you can see we would have been stopped out if the stop loss was placed at this Fibonacci confluence instead of beyond it. Okay, so it managed to reverse off of it, and it's heading back down to our take profit. Okay, so it perfectly reversed off of the confluence area here and towards our take profit. Okay, another example here. So we expect price to bounce off of our entry at 87.625 over here, and the pullback resistance in line with this 78.6% Fibonacci retracement. Okay, and our stop loss is a swing high resistance, take profit is a swing low resistance, support. Okay, so price has hit our entry and has reversed nicely off of it, as you can see here, and is nicely heading towards our take profit. Okay, and then we're using Fibonacci to further complement our take profit levels. Okay, so price just touched our take profit before reversing off of it. Okay, so you can imagine if we had placed our take profit before, beyond it rather, if we had placed it underneath our swing low resistance as well as the Fibonacci level, we would not have been able to catch this before it reversed back up to our stop loss. Yeah. Okay, I think you guys have gotten it by now. Just one more example here. Price recently broke out of this descending trend line. Okay, and we have 3 Fibonacci levels that line up with our take profit here. Okay, and price is currently at our entry. You can see if we place our take profit above the confluence area, price would have reversed off of the confluence area and missed our take profit by a few pips. Okay, so instead of that, we want to place it right below it instead. Okay, so some exit strategies that you can use, which are typically a dynamic stop loss and not just a stationary stop loss or a fixed stop loss. Okay, so trading stop loss. Trading stop loss is a special type of trade order that moves relative to price fluctuations. So we're using a lot of different indicators to support when you should enter or exit your trades. Okay, so when the price goes up, it drags the trailing stop loss along with it. But when the price stops going up, the stop loss price remains to the level that it was dragged to. So it's an order type that's designed to lock in profits or limit losses as a trade moves favorably. Automatic trailing stop loss moves accordingly as price moves favorably. Manual trading stop loss. It's moving stop loss level based on mechanical indicators. Okay, so here are some of the indicators we're using. Okay, firstly, we have you have your moving averages. Okay, and then you have your parabolic SAR, or is that, I think that's the chandelier. And then we have the ATR, we have your support and resistance levels, and then this is your parabolic SAR. Okay, so let's talk about how exactly you can use them. So trading stop loss is over here. we have a sell entry. So our sell entry, here we're using a moving average, and we can see price is moving, it's breaking out of this ascending trend line. Okay. Here, if we're using a moving average as a trailing stop loss, our entry is here when it breaks out of the trend line, and it also breaks out of the moving average. Okay, so we're using breakouts here, moves under instead of over. You can see moving over here, and then it breaks out, moves under, and then the trailing stop loss is triggered over here. Okay, and it got us out before this happened. Okay, another way is by using trend lines. So here we have a descending trend line. Okay, so what makes a descending trend line, just to recap, is to have 3 significant levels that are touching the line. Okay, yeah, minimum 3. Okay, so our entry is here because price has broken out of this ascending trend line. Okay, and it's currently moving in a downtrend. So we have a descending trend line, we have an ascending trend line, and once this trend line breaks out of it, then we are stopped out. Okay, here we're using parabolic SAR. So you see our sell entry is here. Price moves under the ascending trend line, and also the parabolic SAR. You can see it's moving underneath instead of over in this case, until it breaks out of the ascending, or rather, it breaks out of this parabolic SAR line. Okay, and then a trailing stop loss is triggered. Okay, here chandelier and ATR. Okay, same thing, sell entry with this line. And we're using both ATR as well as chandelier in this case. So both moving under, and the trailing stop loss is triggered once price has broken out of these 2 indicators. Okay, so this is how we use it in an example. So here we are using Kiwi dollar, but of course you can use it for any commodity, any currency that you're thinking of trading. So once again, we have a price breaking out of this ascending trend line. Okay, it's also moving, or rather it's breaking out of the moving average, and it's moving downwards, or rather it's moving below. Okay, so here we see price moving above the moving average. Once it breaks below, that's a sign that we could see a change in trend. So it's moving downwards. Here is our sell entry, and we're going in for a sell towards our take profit, which is over here. Okay, at this swing low here. And then we are stopped out when price hits this moving average and breaks above it. Okay, last example, dollar CAD. This is a support and resistance example. So we see price once again breaking out of this ascending trend line. So that's our sell entry, with our stop loss placed just slightly above, and I'll take profit at the swing low here. Okay. Okay. Now, let's take a look at, let's maybe analyze gold together now. Okay. So I like to start off by looking at the higher time frames first, the weekly and daily time frames. Okay, because then I get an idea of what the general directions are of the trend. So you can see there is an uptrend here, but it looks like there has been a recent reversal. If we look at our daily time frame, Okay, we don't have any trend lines or trend channels here. Yeah. Okay, we don't have any trend lines or trend channels, but we can see price definitely moving slightly in a downtrend. Okay. Okay, let's look at our 4-hour time frame. 4 hours is it looks kind of bullish here, even though there is a reversal recently. And let's look at 1 hour. Okay, 1 hour is pretty bearish. Okay, so if you want to compare, let's take a look at DXY. Okay, so if you're not super sure what the directions are, you can always compare with DXY, since we mentioned that DXY as well as gold tends to be negatively correlated. Okay, so we see prices kind of increasing on our DXY. So we can expect the opposite on our gold. Okay, I'm not sure why it's bugging out on me right now. Okay, yeah. So you can see it's moving downwards, whereas DXY is moving upwards. Okay, so let's go in with our support and resistance levels now. Or actually, let's see if we can find any channels. So the first step is always to look for the general trend. So you want to see if you can find any trend lines, which I can see over here. I have a descending trend line with 3 significant touches, as you can see. I can also see that price is moving in this descending trend channel. Okay, so for a valid trend channel, you need 2 touches on top and 2 touches below. And now let's go in with our support and resistance levels. Okay, so I try and pull it back as far as I can, so without cutting too many candlesticks, so that I can see how significant this level is. So here, this is my first resistance. This may be my first support. Okay, and then maybe here. So this is purely graphical, just by looking at support, just by looking at the swing highs and swing lows. Okay, so it's not, you can always go in with your Fibonacci levels and adjust them accordingly. Okay, so now I'm gonna go in with my Fibonacci levels. Here you can see my 23.6% Fibonacci retracement lines up nicely. And okay, my 78.6 also lines up nicely. I think my 100% also kind of lines up with my first support, because these don't necessarily have to line up exactly, because they're more so areas than levels. Okay, and I like to get rid of the 0 and 100 if it's not necessary. Okay, let's see what else we have. Okay, my 23.6 lines up with my first support as well. Okay, so you can see that this first support is pretty significant here. Okay. Okay, I think that's all the levels that we have. Now let's go in with some indicators. Okay, price is moving below the Ichimoku cloud, so it's in line with our bearish signals, whereas MACD is giving us a bullish signal. So I'm going to get rid of that. And let's look at RSI. Okay, RSI isn't really telling us much. Let's take a look at moving average, EMA, and SMA. Okay, so price is moving below our EMA, so it supports our bearish signal. And over here, we see that price has crossed over, which signal a change in trend. And you can see price definitely did drop over here. Price is also continuing to move below our SMA, which also supports our bearish signal. And because they haven't crossed over each other, we can continue to expect that price is going to continue in this downtrend. Okay, but I will say that because there is a confluence area here at our first support, and that's why you see price being attracted to this area, we could see a bit of resistance here and price reacting off of this area as well. So yeah, just keep that in mind. Maybe let's look at Bollinger Bands as well. Okay, okay, on our Bollinger Band, you can see price. Let me make it bigger. Can see price pushing below the lower band of our Bollinger channel, which is also a bearish signal. Okay. So yeah, we could see prices continue to drop here. Okay. Let me know in the chat if you guys have any questions. Okay, if not, that's all I have for you guys today. Thank you guys so much for joining me. I hope you guys found it helpful, and I will see you guys next week. Have a great rest of your week, and see you guys soon. Bye. Thanks, everyone.